Joining me today is Ellen Brown, author of the book Web of Debt, as well as a few other books. Today with Ellen, we're going to talk about the ongoing banking crisis, especially the trend of bail-ins, which Cyprus is sort of perhaps a warning shot. Will that continue? What should investors and traders and actually anyone with a bank account sort of know about this topic and consider? Ellen, thanks for joining us.
Thanks.
So I guess the first question is, or just to recap sort of where we're at for a lot of people who may not be following the story. And it seems like, there's that community of people that are interested in this subject, traders, investors, monetary, or that's realm of politics where they're really focused on monetary policy. In Cyprus, part of the, Eurozone situation, 37.5% of deposits, uninsured deposits, so that's above 100,000 euros, were confiscated. Another 22.5% were told or were allocated or assigned the potential for future confiscation, and then 30% were temporarily frozen. So that's 50, 60, that's like 90% of uninsured deposits, something was going on with them. I think the first point to start at is, did I recap that situation correctly? Would you agree with that basic assessment? And then if so, or if not, or how likely is the idea of bail-ins to spread, especially in places or in the Western world, United States, Canada?
Well, your figures are later than mine. Last I saw was 60% of the uninsured deposits were getting they were going to be turned into stock. So they were turning debt to equity. But what good is your stock in a failed bank? You can't exactly pay your rent on it. Of course, these are big investors, so they're probably not paying their rent off it. But anyway, they're losing their money, yeah. And we know that this pattern or template is being pursued around the world, or will be pursued in the event of the collapse of other big banks, because there was a directive from the Financial Stability Board, which we all signed on to, the G20 signed on to in 2009 after the 2008 collapse. So we agreed to be bound by their rules. And so they issued this directive in 2011 that said that all the central banks should have these things set up where, or all the, I guess our directive is between FDIC and Bank of England. So FDIC isn't actually a central bank. But anyway, that they should have these policies where the banks have to do their own living wills, as it's called. So they have to figure out what they would do in the event of a bankruptcy in order to avoid bankruptcy. In other words, in the event of insolvency. Because the theory is that these banks are too big to fail and that they have to be rescued no matter what. And so what they're going to be rescued with is the creditors' money. Well, it turns out that the depositors are the largest class of creditors of banks. Unlike what most people think, when you put your money in the bank, it's no longer yours. It becomes the bank's money and you become a creditor. All you have is an IOU of the bank. So if you have a demand deposit, the deal is, basically they're saying, we don't have it, but if you want it, we'll get it for you on demand, which they always can do because they can always get it from whatever bank it just went into, because they do all these overnight sweeps and they borrow overnight to settle up their books with these repos. And then they pay it back the next day. That's the way the whole thing works, that if you're short at night, you have to balance your books. So you borrow it for somebody who's got extra, and then you give it back in the morning. So sort of a check kiting scheme, but that's how it works. So anyway, normally that works, but in the event of a big collapse, if we have a big derivatives bust, the two big derivative banks in the US are the JP Morgan and Bank of America. They both have over $1 trillion in deposits. They have over $70 trillion in notional value of derivatives, and the FDIC fund only has $25 billion in it. And it used to be that the FDIC could then borrow from the Treasury for the rest and make it up with the premiums from their members. But even when they've done that, like when they went $8 billion in the hole, that really put a stress on the members, the smaller banks. That was a big chunk for them to make this special assessment. What happens if we have another $700 billion bust? Now Dodd-Frank says that we, the taxpayers, are not going to bail out the banks in the event of a big gambling loss, as opposed to an ordinary sort of bank loss. So we've said, so in Dodd-Frank, they're basically saying, well, you can go ahead with your casino, but don't look to us if something goes wrong. So there's a question whether there's even this credit line still there with the Treasury, but even if there was, who's going to pay it back? So in other words, now the banks are realizing that the governments aren't going to bail them out anymore. Iceland was the leader. They said, forget it, we're not bailing out your two big banks. And I mean, the people took to the streets and they said, we're not going to do it. And they persuaded their politicians. They had a big populist movement and they didn't bail out the banks. Dodd-Frank says we're not going to do it. The Europeans are balking. The German banks are balking at bailing out the Greek banks. So it's clear that they're going to have to go somewhere else. So the plan is go for the creditors, which means us, the depositors.
So you mentioned that this plan has sort of been in place since 2009 through something known as FSB. I forget what you stated that standard for. Is that a part of the, or is that related to the IMF or the UN? It seems like a global organization. Could you shed some light on how it fits into the realm of global governance?
Yeah. Well, it was first set up after the 1997-98 Asian crisis, and it was set up by the G7 as a global stability forum. So at that time it was just guidelines, just suggestive. You didn't have to do it. But after the 2008 collapse, then the G20 got together and put their heads together, supposedly, and all agreed that we needed some sort of global regulation, and they all agreed to abide by these regulations. But it was very vague. They didn't say what it was, what the regulations were going to be. It's under the Bank for International Settlements, and they're all in the building there in Basel, but they're technically separate from the BIS, but the BIS is a member of the Global Financial Stability Board. So they are the big.
So I guess.
Go ahead.
So I guess the one common or one I think response would be this: in Cyprus, they don't have their own. They're not in control of their own money supply. So that's the European Central Bank is regulating that. The argument or on a common theme in terms of forecasting how a situation might be different in Europe versus Japan and the United States, where in Japan and the U.S. there's a greater, basically, I guess the simple argument is, would the U.S. government or the powers that be or the people in charge, would they really take deposits? Wouldn't the inflationary route of just it goes back to the derivatives crisis, like you noted. So there's $1 trillion or however much in derivatives that these banks have, and that's really where the need for a bail-in or the need to resolve this crisis comes through. Isn't the inflationary route sort of the safer route in terms of people will end up accepting it and the banks still sort of don't really have to pay for it? Or do you not see it that way, or it doesn't really matter because they pass these laws? What are your thoughts sort of on that issue?
I think Ben Bernanke said they were not authorized to bail out the banks in that type of situation. So that's the thing. They have new rules now under Dodd-Frank that they'd have to change them back. I mean, the thought is that they're saving the taxpayers, but what it means is that they're going to go after the depositors, which is even worse, because if it's a tax, it's spread out over the whole population of its depositors. It's just the depositors for that bank. Although even if you're in another bank, it's not safe. They're all interconnected.
Now that's so is it in Cyprus? There's the issue of uninsured deposits. Now this crisis, was the derivatives is 1 quadrillion, or a lot of it's OTC, so the amount is, I don't even know if it's 100% clear. We know it's big, huge. For people who have less than $100,000 in their bank account, are they sort of safe in a way? Do they really have to worry? Or someone who has 5,000, 10,000, even 50,000, 90,000, can they really trust their money in the bank account? Or how much risk are they exposed to versus someone who has 10 million? Or as well as businesses, huge corporations, Apple, Google, things like that. Is there a different risk parameter for the small individual, the wealthy individuals, and the larger businesses?
Well, the small individual that's what I'm saying. Theoretically, they're covered by FDIC insurance, but FDIC doesn't have the money. So who's going to pay? That's the question. They can't even get, if it was a big collapse like in 2008, they're not going to be able to find 700,000 or $700 billion from the other small banks. They can't afford to pay that. So that's why they have these policies in place, that they'll go after the creditors, which they're being very vague about that, but the creditors do mean the depositors. Most people don't keep all that much money in the bank. It's just enough to cover their rent and all the things that they need liquidity for. And if they have big money over that, they probably have it in the stock market or some other market. But all those markets are vulnerable. For example, I called Scottrade, because that's where I have my extra. And they said, yes, they put their money in these overnight sweeps in Wall Street banks. So, a Wall Street bank, they always go bankrupt overnight or over a weekend. So your money's liable to be there, even if it was your excess funds from your stock account or in any of those money market, whatever. It's liable to be in Wall Street overnight, because they all kind of shift their money around overnight. The money markets all lend to Wall Street, and that's the reason that was what the big problem was in 2008. It was the money market that collapsed, not the conventional banks. So the whole thing is very unsafe. So my whole thing is, I'm president of the Public Banking Institute, and what we think the solution is that we need to set up a publicly owned system, a system where we have one model, the Bank of North Dakota in North Dakota, that's where the state itself has its revenues in the Bank of North Dakota. Then they can use all their capital and their deposits they can leverage that money to credit for the state. So they partner with the local banks. They guarantee the local banks, so they help them with their capital requirements. They participate in the loans, and they make credit available to the local economy. And they have the lowest unemployment rate in the country, the lowest default rate on loans, the lowest foreclosure rate. They have low student debt rates, etc. They have many, their economy works very well, and they missed the credit crunch. And globally, 40% of banks globally are publicly owned. These are largely in the BRIC countries, Brazil, Russia, India, and China, which also escaped the credit crisis and are growing like gangbusters. They've grown 92% in the first decade of this millennium, compared to 15% for Western countries. So it's not only North Dakota. I mean, you could say, well, our state's different from North Dakota for some reason, but there are banks globally that are publicly owned, that are servicing their local communities, and they're doing much better, and they're much safer than our banking situation.
So is that, are you basically saying that, I'm just trying to understand if I'm interpreting what you're saying correctly, like are you advocating the Fed being nationalized? Is that sort of one solution?
Good idea, but there are many countries that technically own their banks. I mean, Bank of England is owned by the government of England, but it still serves the banks. They still are under this financial stability board, etc. But I'm suggesting that if we had local, state, county, and city banks, where the states, counties, and cities put their own revenues, then they have credit engines for their own local communities. But you could set them up so that we could have local depositors as well, and we would have a safe place to put our money that was government backed, because it was the government, but it's our local government.
Do you have any thoughts on, or are you familiar with, or have any thoughts on Bitcoin and cryptocurrencies like that? Do you think that's a feasible solution, or?
I think it will be a feasible solution. Right now, it's so, I'm hesitant to to buy in because it's just so volatile. You could easily buy at the top and just watch it crash. But if they get
Right.
that part worked out, it's a great idea. I mean, to have an independent currency system that's safe. It's right now. It's a very good. I mean, I'm not in this position, but I heard somebody else who does international dealings. He says it's a great system for immediate trades. In other words, if you know the price today and you say, "All right, I'm sending your money right now," and they get it at the other end right now, then they know the price. The Bitcoin's not going to fluctuate that much over a short period of time. So it's great for that right now. But I think it does have promise in the future if it gets stabilized for an alternative way that we can trade and an alternative place we can keep our assets.
So it seems like some type of pretty substantial monetary reform is something that you're interested in, that you've put forth. In terms of but in terms of immediate solutions, so a monetary reform probably might take, months, years. In terms of now, how imminent is the bail-in crisis in your opinion? Are we at a risk of a shutdown in the banking system and deposits being seized, any day now? And if so, what are ways that people can protect themselves, or any ways that people can protect themselves? The stock market's vulnerable, futures and forex markets are probably even more vulnerable. What are some ways? How concerned should people be in the near term, and what are some ways that people can protect themselves, if at all?
Well, it always happens overnight. I mean, you always hear about when these crashes happen that people didn't have warning. You just open up your computer one day and you see that either your account's been wiped out, or you just see these arrows dropping straight down. Lehman Brothers, we ordinary mortals didn't know that was going to happen before it happened. In Russia, when they went bankrupt, those things just happen quickly. So it's definitely worth protecting yourself. But as for what to do, I don't know. I mean, just for your own deposits, credit unions are probably the safest. But you can't do much. Like if you have a business, you can't really run it out of a credit union very well. And if you're state and local government, you definitely can't use a credit union. So that's why I think we really need to get on our legislators to set up their own safe, publicly owned banks, and to ideally allow us to use them too. But even if only the state and local governments use them, they could then partner with the local banks, which would make the local banks stronger. Right now, the Wall Street banks are eating up the local banks. We hardly have local banks anymore. Where I live, we don't have local banks. The two local banks where I used to bank are now Chase Bank and US Bank. They both got taken over.
In terms of so at least with stocks, or for people who have their money in them, I mean, is there a difference between stocks and cash in terms of what's safer at this point? Or it seems like thus far in our conversation that, it's all connected, so one might not be safer than the other. What are your thoughts on that? And does direct registration versus street registration, is that something that you think makes a difference for if you're going to hold stocks?
Well, I've heard that direct registration is pretty difficult to do. Is that right? I've never tried it.
or at least, I have an account with Scottrade as well, and they have a DRS form. I completed and submitted it and transferred it. So it didn't cost anything. It was pretty safe. I guess when I look to sell, there's going to be a little bit of a delay, because I have to transfer it back to street registration. I don't know. I guess to me that seemed like it might be somewhat safer, but I'm sort of looking at this as a who knows really in terms of trying to try a bunch of different things. So I have a bunch of stocks still in street registration, a bunch in direct registration.
It's probably a good idea to have your money in many different places. The trouble, I used to think, well, when I'd get nervous about my stocks, I'd think, well, I'd sell, and then I'd think I'm better off with the cash. But if your cash is going to go into this overnight sweep and then could crash on Wall Street, then you're actually better off owning the stock. In fact, arguably, you're better off owning a house or anything, you know, putting your money into a real asset. That now's the time to buy things, I guess, because they're probably not going to devalue.
Sure, non-financial assets that you can actually touch and hold and
A new car.
beyond a piece of paper. Okay, I think that's about it for in terms of the questions I have. Could you tell us more about how people can find you, your upcoming book, and some of the things you're working on?
Okay, my websites are webofdebt.com. My book that got me into all this was called Web of Debt, and it's available on my website or on Amazon or many places. And our Public Banking Institute website is publicbankinginstitute.org. We have a big conference coming up June 2nd to 4th in San Rafael, California. So the details for that are on that publicbankinginstitute.org. Matt Taibbi is our keynote speaker. Birgitta Jonsdottir is coming from Iceland. She's one of the politicians who stood up to the banks, so she's going to tell us how they mobilized the population there. Many other great speakers. So I'm looking forward to that myself.
Sounds great. So we'll have links to Ellen's website on informedtrades.com and below this video on YouTube. Ellen, thanks a lot for joining us.
Thank you.